Ladies and gentlemen, may I now invite our next speaker, Shri Ankit Jain, co-founder and CEO, StepChange, to throw some light on calculations of financed emissions. Shri Ankit Jain is the co-founder and chief executive officer of StepChange, a leading corporate sustainability platform. Prior to this, he ran Ola Electric Mobility, where he was a board member and a co-founder. He holds an MBA from MIT Sloan School of Management and is a BTech in Computer Science from IIT Bombay. Over to you, sir.
All right. Hi, everyone. I'm standing between you and lunch, so I'll try to be quick and I'll try to keep it quite simple. We've talked a lot about climate today already, so I won't spend a lot of time on my initial slides. We know climate change is happening. We know it's happening faster than any time in history. We even know that if we stop today, things will still get a lot worse. Because just like how in a car it gets heated over time, greenhouse gas happens over time, right? So whatever we've been emitting over the last 10 years, the impact of that is yet to be felt, right? So whatever we are feeling today is nowhere close to how bad it's going to get, right? And if we continue doing what we are doing today, of course, things are going to be much harder. We all know all of that. So hence net zero goals, becoming sustainable is important. But it's important because it's not just that things get worse, it's because they get unpredictable, right? So there are certain things which we can predict which will happen for sure. Sea levels will rise, glaciers will melt, and so on. But there's a lot of other things which just get unpredictable, right? And unpredictability brings risk, right? And it starts to impact different systems that we have. Those systems will be socioeconomic systems. Those systems will be our terrestrial systems, our food systems, human health. And there is, of course, feedback loops in all of them, which increase the potential impact on the overall economy, on the overall, on humanity as a whole. So again, not spending a lot of time on this. We've talked about physical risk, transition risk, chronic and acute, as well as regulation-driven, technology-driven. All of that is stuff, and I think we'll continue to talk about that. My focus today will largely be to talk about greenhouse gas emissions, and specifically in that context, financed emissions that sits in your portfolio. Now, greenhouse gas emissions, and we'll talk about India, disproportionately in India sits in sectors like power and industry. Right? Almost 33%, 34% is in power, another almost 30% sits in industry, another 20% sits in agriculture. If you think about all the noise around EV, and I used to lead an EV company, so I'm saying it with full realization, two-wheelers, three-wheelers, passenger cars are insignificant compared to all the other sectors we are talking about. Right? Transportation is only 9%, and majority of that is buses and trucks. Right? So it's important to come back to what is really driving emissions in India, and hence what should you really be trying to finance? What transition are you really focused on? So renewables, of course, is a huge part of what India needs to do, but we need to really start thinking beyond that to industry, to agriculture, to waste, and so on. I'm assuming everyone's aware of scope 1, 2, 3 emissions. Scope 1 is emissions that come out of, literally gases that come out from within your operational boundaries as a company. Scope 2 is usually electricity in India. And scope 3 is everything else, from everything you buy, to your transportation, to the use of your products, to leased assets, to your investments, right, which is the last one. Scope 3 is usually about 80 to 90% of any company's emissions, except a few sectors. Right? So and those sectors tend to be the hard-to-abate sectors, where scope 1 and scope 2 are much larger. But in almost every other sector of the economy, scope 3 is 80 to 90%. And disproportionate amount of that scope 3 sits in the category called purchased goods and services, essentially your supply chains or your borrowers' supply chains. And a lot of those supply chains tend to sit with SMEs, right? So this is where it comes back to data collection. How do you get data about real economy that then feeds into both the borrowers being able to estimate their scope 3, because everyone just measuring their scope 1, scope 2 is not going to be enough. The top 1,000 companies, they are mandated to report scope 1, scope 2. That will be a very small part of India's emissions. But when you think of it as a bank, your scope 1, if you assume that to be 1, your scope 3, excluding financed emissions, will almost be 10x, just like rest of the sector. Right? Because you also end up buying a lot of things. There's a lot of things that you ship, a lot of other types of activities that you do in the business. But your financed emissions is almost 100x. It would, in fact, be closer to 200 to 500x. But that's the order of magnitude that we're talking about. And hence, as a bank, the key thing for you to focus on is financed emissions, right? That's where you can have the most disproportionate impact in helping drive decarbonization. And this is not just some international numbers. We've now done this work for many of the large banks in India, and this has consistently been the case. Now, getting in a little bit into portfolio emissions and what it takes to calculate that. So the standard for measuring PCAF, it's a global standard, it's a global standard. It was started by it was an industry-led initiative. It was not something that was mandated by UN or came out of the GHG protocol. It was started by a bunch of Dutch institutions, then got adopted by a bunch of European institutions, and then Americans, and then rest of the world. But today, over 400 financial institutions have adopted the PCAF standard. This is the global standard. There is no other standard that you necessarily need to align to. So at least that clarity is useful. What it does is, for 6 very specific categories, it defines how you go about measuring financed emissions. Those 6 categories include all your corporate loans, your SME loans, mortgages, commercial real estate, vehicle loans, and project finance. Where there is a gap is essentially personal loans and agriculture loans. And agriculture loans, largely because in India, agriculture loans are personal. They are not given to SMEs. And hence, that's also not covered. So that's a big hole, and we'll talk about how to fill that gap. And they give you, and this is a great framework for you to start thinking about where are most of your emissions sitting, in what sectors, what to do about it. And they also realize that one of the biggest challenges in doing this is the quality of data. Which brings us to the next slide, where they've given detailed guidance on how to think about data quality. Right? So there is score 1 to score 5 for each of the 6 categories of loans we talked about. Score 5 being the lowest. Now, okay, I'll take a step back. The way you go about measuring financed emissions is actually quite simple. You have to estimate the emissions of the underlying asset. That asset could be a vehicle, it could be a home, it could be an SME, it could be a corporate, it could be a project. And then you have to say how much of that gets attributed to me. The attribution itself is quite simple. It's your outstanding loan to the company over the enterprise value of the company, if it's a listed entity. If it's not a listed entity, it becomes book equity and book debt. If it's a vehicle, it's the value of the vehicle at the time of giving the loan. But it's your outstanding loan over that number. Right? So the attribution is simple. In some ways, PCAF doesn't differentiate between equity shareholders and debt. Right? So if you think about it, outstanding financing, right? So it could be outstanding loan or it could be outstanding investment over the enterprise values. So they're being treated equally. The harder part is how do you go about measuring the emissions of the underlying asset? And that's where you have these 5 data scores. So here, for example, for corporate bonds or corporate loans, you can start with category level estimates. So you don't have to even go down to loan level. You can just take your 40 categories or 100 categories that you use to report your data to, for example, RBI every month, and literally do this exercise on that. It'll at least tell you what your hotspots are, where most of your emissions are sitting. The next step is to perhaps do revenue-based estimates, which is score 4. From there, you can move to production-based estimates. So the difference between revenue and production would be, for example, knowing the revenue of the company, which all of you already know. So score 5 and score 4, any of you can do today with absolutely no problems. All you need is emission factors for different sectors, right? All of the other data you have. Score 3 is where data starts to become a bit of a challenge, right? So for score 3, you need to understand how much production of what type of SKU is the company doing. How many tons of steel are they making? How many tons of cement are they making? How many room nights have they sold? And so on. Score 2 requires you to get a lot more granular data about the energy consumption, coal consumption, electricity consumption, etc. And you're effectively calculating emissions on the company's behalf, which is, of course, a challenge to get that amount of data. And score 1 is just reported emissions, reported and validated emissions. So in fact, for top 1,000 entities in India, you'll directly be able to go to score 1 and score 2. Right? Because top 150 will be getting it reasonably assured from next year. So you'll have score 1 directly. For the remaining 850, you'll have score 2 because they'll be measuring it but may not be getting it reasonably assured. Right? So for a big part of your corporate portfolio, this becomes relatively straightforward. This is slightly more complex when we look at mortgages and vehicles because there you have to estimate, given whatever you know about the mortgage loan, how to estimate the energy consumption of that home. Given whatever you know about the vehicle, how to estimate the fuel consumption of that vehicle. Right? And that's where companies like us come in because we build those models to help you operationalize this. Now, to give you a sense of the accuracy of these different scores, right? So we took a scenario. We said, let's take Tata Steel, where all of these scores can be applied. It's a public company. All of their data is available. We assumed a 500 crore loan to Tata Steel and implemented PCAF score 5 to PCAF score 1. And you can see that the accuracy of score 5 and 4 tends to be lower because you're using category level estimates. Now, in this case, we would have used iron and steel sector estimates. Now, because iron and steel also has a lot of steel companies, which are, let's say, going from recycling steel to make steel products, their emissions tend to be much lower than someone like Tata Steel that is going from iron ore to steel. Right? So when you actually move to score 3, you move to score 4, score 5, you get more accurate, their emissions go up. This could also have happened the other way around. But essentially, score 4, score 5, great for heat mapping, getting a broad sense of where your emissions are, understanding whether it's disproportionately power or is it disproportionately in iron and steel or cement or mining or petroleum or any of the other hard-to-abate sectors, or is it in aviation. Score 3 to 1 is where you really start to get a sense of where the company sits and how they do within their sector. All right. Now, the way you go about doing this, and this is our recommendation, of course, is you start by doing score 4 or score 5. Score 5 is very easy. You can very quickly do that using data that, as I was saying, you anyway report to RBI every month. You heat map which sectors are driving most of your emissions. Take 80 to 90% of your emissions, right? So that will exclude a lot of long tail services sectors, personal loans, etc. will get removed. And then for those, try and go to score 4, right? Go down to the loan level, take the revenue, take the outstanding loan, EVIC, etc. All of that is sitting in your banking systems. You get someone to give you the right emission factors, apply that, and you can get to score 4. This is also relatively straightforward. You can use that to then benchmark yourself against national peers, international peers. There's, as I was saying, over 400 financial institutions globally that have signed up to PCAF where this data is publicly available. We'll also show you, we in fact did this exercise for all scheduled commercial banks. Right? In fact, for somebody like us, we can do it for any bank in India because all of you do Basel III disclosures. So we can just take that and actually tell you your score 5. But the most important thing that comes out of this exercise is you realize what are your data and systems gaps. Where do you not have enough data to go to a score 3 or a score 2? What are the gaps in your system? What data are you not collecting? And then that feeds into your overall roadmap for your IT and other systems. Moving to the next phase is where we are seeing banks now start to move to loan level financed emissions, score 1 to 3. For a lot of corporate top 1,000 listed entities, that's data that's available. You're able to move there fairly quickly. For others, you have to start collecting data. And that's where you need to build the right data streams, need to build the right IT systems to collect that data and measure those emissions. Finally, we recommend everyone to start thinking about setting internal goals at least. We had Mr. Tiwari earlier talking about SBI setting an internal goal. If one of the largest banks in the country can do that, I think so can everyone else, and at least start to move in that direction, because once those targets are set, it starts to create an internal momentum towards driving action. And finally, the hardest part is going to be using all of this and doing this during loan approvals, during loan renewals, and making it part of your credit process. And that's where you'll start to also incorporate into things like transition risk, where financed emissions is an important input. Yeah. And finally, of course, start to report on this and make it publicly available so that your investors can understand this, the regulator can understand this, and transparently share that. Great. So this is one money slide I wanted to share. So we took the data that RBI reports on all scheduled commercial banks in India. On right-hand side, you'll see that in India, 34% of the loan book, which is about 142 lakh crores, is in personal loans, followed by industries is 25%, 28% services, and about 13% agriculture, which accounts for almost 770 million tons of CO2, order of magnitude, vis-a-vis India's emissions, which are about 3 billion tons of CO2. To put this number in perspective. Yep. This will be larger than any European country, by far. Yep. Majority of that, over 60% of that, comes from the industry, as you would expect. A large part of that through power, iron and steel, cement, mining, and so on, which we are aware. But also, a big chunk of that is expected to come from agriculture. Now, that number is the least reliable of all numbers, because agriculture is where there is poorest data in banking systems. Right? Today, for example, you might capture that you're doing crop loans, but you may not go down to the level of saying whether it's paddy and what type of paddy. Right? And of course, we know that paddy has much higher emissions than wheat. Right? So that type of data has to be captured to start to calculate this more accurately. Yeah. The third biggest one tends to be personal loans, which is largely driven by vehicle loans and home loans. Now, what do you do about all of this? There's some guidance, of course, from GFANs. The biggest thing, if you haven't already, start setting internal targets on green financing. Right? That's what this day is all about. So highly recommend everyone setting ambitious targets on just green financing, transition financing. But you will have to go beyond that. Right? You will have to go look for companies that have started to set targets. Right? There's over 100 companies in India that have signed up to SBTi. Right? That means they have to get to net zero by 2050, 20 years ahead of India. Right? Go support companies like that, lend more to companies like that. Then work with your existing companies who've not set targets and push them to start setting those targets, help them figure out how they can transition. And there's, of course, the last part of moving out of certain companies that are not willing to do so. So summing this up, there's 6-7 things that we would recommend doing. This is basis our learning of having now done this exercise with almost 6 banks in India, is first of all, update your internal taxonomies to start including climate categories. Make sure a lot of loans just tend to sit in these categories called others. Clean that up. Let's try and put those into specific things so you can measure those effectively. Accurate and continuous monitoring of financed emissions. You can start, as I was saying, score 5, score 4, score 5 very easily, and then move to higher scores over time. Commit to net zero targets, at least internally. Set some targets for some portfolios or some sectors. Then move to start measuring physical and transition climate risk. That's a much harder part, and I'm sure the panels will talk about that in more depth. Finally, the things that you do to drive transition. As I was saying, dedicated push to finance emerging green sectors, which we've talked about today. Think about how you can create incentive mechanisms for core sectors to decarbonize. Right? You will have to work with the hard-to-abate sectors. So it's not just green sectors, but it's also transitioning the brown sectors that matter, as was talked about earlier. And finally, think about agriculture. It's a big part of India's emissions. You have big CSR budgets. Can you somehow use that combination to encourage more sustainable agriculture practices in farmers that you are lending to, or NBFCs, MFIs that you are lending to, and through them the farmers that are being lent to? So how can we create more sustainable agriculture also in India? With that, that's it from me. Any questions, or am I done? Cool. I'll take any questions outside if need. Thank you.
Please wait back for a moment. Sure. Thank you for the insightful presentation. Chandrasekhar sir, may I invite you to present a memento to Ankit Jain.
Thank you. No, that's fine. Thank you.
Thank you. Nair as a token of love and affection.
Lastly, I need apologies for jumping at you. Somebody was there in the panel at extreme spot.
Thank you very much, sir. Thank you.